Welcome back to the deep dive. Today, we're going way, way beyond the usual charts and indicators you see everywhere online.
We are.
They're taking a scalpel to the markets, really looking at the playbook, the actual wiring that serious institutional players use.
That's a perfect way to put it. Our deep dive today is all anchored in this really comprehensive framework from the book Mastering the Markets, a professional trader's guide.
By Sir Margin and Khumo Solutions, PDY.
Exactly. And this is a key distinction we have to make right up front. We're looking at how to build a sustainable process, not chase some, magic formula.
And the backstory of the author, Sir Margin, it really sets the stage for everything. It's a classic story of painful failure that leads to real mastery.
But trial by fire.
Absolutely.
Yeah.
So back in the chaos of March 2008, he lost a staggering 63% of a $150,000 account. Just gone.
And that kind of loss, that's a crucible. It either breaks you or it forges you. For him, he didn't quit. He spent the next 15 years just diving in, mastering institutional risk, market structure, all of it.
Which led him to this core non-negotiable principle that really defines the whole book.
Yes. The market rewards process over outcomes.
And that is just, it's so counterintuitive for anyone starting out. Everyone is glued to their P&L, right? The outcome.
Of course.
But this framework says a losing trade, if you executed it with perfect discipline, is actually better than a winning trade you took on a whim. How does that make sense?
Well, because the market is designed to, randomly reward bad habits. Just enough to keep you hooked. That's the noise.
The short-term randomness.
Right. But if you want to survive and actually scale over years, you need an edge that's mathematically sound and, just as important, emotionally resilient. A bad process guarantees long-term failure, even if you get a few lucky wins.
So our mission today, for you listening, is to really map out that transition. How do you stop being a retail trader chasing patterns and start acting like a professional who's building a real sustainable edge?
And that has to start with understanding what the market actually is.
And what it isn't.
Exactly. We're often told it's either totally random, like a coin flip, or it's perfectly efficient, where all information is priced in instantly.
And the sources say it's neither.
It's neither. They are complex adaptive systems. CAS, for short.
Okay, CAS. That sounds pretty academic. Let's break that down. What does that practically mean for someone at their screen?
Think of it like a weather system. Or maybe traffic in a huge city. It's complex because you have millions of independent people traders all making their own decisions.
And it's adaptive because every single one of those people is learning. They're changing their strategy based on what happened yesterday.
Precisely. Which means what works today might not work tomorrow. That's where you get these non-linear dynamics.
The butterfly effect.
The butterfly effect in markets. A tiny input, like a slight change in wording from the Fed, can create a massive outsized reaction. This leads to what they call phase transitions.
The whole personality of the market can just shift.
Abruptly. It can go from a quiet, trending market for months, and then boom, overnight, it's a volatile, choppy mess. Knowing which regime you're in is half the battle.
This complexity also leads to this idea of an efficiency spectrum. We know big stocks, like Apple or Microsoft, are micro-efficient. News gets priced in.
Instantly.
So where's the edge for a human trader?
The edge isn't in trying to be faster than the algorithms. It's in exploiting the macro inefficiencies, the longer-term mispricings that happen because of, human behavior. Bias.
Herd behavior pushing prices way out of line with fair value.
That's the sweet spot. And to find those pockets, the framework demands this integrated approach, the 3 dimensions of analysis.
Okay, so this is the core foundation.
It is. You have to look at the technical, the fundamental, and the behavioral. Most retail traders get stuck on number 1.
Technicals, that's the what? It's the price action, the patterns on the chart.
Then you have the fundamental, which is the why. Why is this moving? Earnings, economic data, that sort of thing.
And then the third, which seems like the hardest, but maybe the most important, the behavioral, the who.
The who.
Yeah.
Sentiment, positioning, crowd psychology, who is trapped, who is about to panic.
The most powerful signals, then, are when all 3 of these align, the convergence zone, as the book calls it.
That's it. So picture a stock that's sitting on a major technical support level. Fundamentally, they just had great earnings. But the behavioral picture shows, say, extreme pessimism in the news and high short interest.
That's your high probability setup. It's not just a line on a chart. It's a story.
It's a complete story. And professionals have a process for this. A daily 15-minute market structure analysis.
And it's not just flipping through charts.
No, it's analyzing the macro context, what's the dollar doing, it's identifying key levels, and crucially, it's something called liquidity mapping.
Okay, liquidity mapping. That sounds very inside baseball. What is that operationally?
It's figuring out where the big pools of orders are, specifically where are the clusters of stop-loss orders from retail traders. Because professionals know that price is a heat-seeking missile for liquidity. If you can see a giant pile of stops just below a key low, you can bet that's a target.
A stop hunt.
A stop hunt. And that idea moves us perfectly into market microstructure, the plumbing of the market.
Right, the hidden mechanics, because how an order is executed actually physically moves the price. Let's talk about order types.
Yes. Think of it like traffic. A market order is a car just flooring it to get through an intersection. It's a liquidity taker. It moves the price.
Which is why big institutions are so careful with them.
Exactly. Then you have limit orders. They're the cars waiting patiently to turn. They are liquidity providers. They create these little temporary walls of support or resistance.
Speed bumps.
Great analogy, speed bumps. And then you have the famous one, stop orders.
The accelerator.
The accelerators. When a stop is hit, it turns into a market order and just pours fuel on the fire. And this is why knowing where the liquidity is matters. You have to place your own stop beyond the obvious cluster of retail stops.
So you don't become the fuel.
You don't become the fuel. This all plays out in a very predictable pattern called the liquidity cycle.
A four-stage dance.
It starts with accumulation. Smart money is buying quietly. Then comes the stop hunt, that sharp move specifically designed to trigger all those stops we just talked about.
And they do that because they need the other side of their trade, right? They need sellers to fill their huge buy orders.
Precisely. It's not malicious, it's just mechanical. Once they've grabbed that liquidity, you get the real move, the breakout. Then eventually distribution, where they sell to the excited new crowd.
And finally, the reversal.
The book gives us a perfect example of this. The NASDAQ 100 futures, the NQ, back in October 2023.
Okay.
The NQ was consolidating around 15,800. Then on October 26th, a sudden sharp drop down to 15,680. A classic breakdown, right?
It looks like one. Everyone would be panicking, selling.
But if you understood microstructure, you'd see it for what it was. A pure liquidity grab. That was the stop hunt, hitting every single retail stop parked under that support level.
And what happened right after?
The second those sellers capitulated, the price snapped back. It just reversed on a dime and shot higher. The whole point is, you buy the reversal after the capitulation. You don't join the panic.
And you can see this institutional intent even more clearly with volume profile analysis.
Yes, volume profile is like an X-ray of the market. It shows you where the real business was done. The biggest bar is the point of control, the POC.
The price with the most volume.
Right. Think of it as a magnet for price. It's the market's fair value area, so price tends to come back to it.
And the opposite of that would be the low volume nodes, or LVNs, the gaps in the profile.
And those gaps act like express lanes. There's no friction, no resistance there, so price can move through them incredibly fast.
So you can almost predict where momentum will just explode.
You can anticipate it, yes. And this all ties into execution. Professionals are obsessed with slippage management.
The difference between the price you click and the price you actually get.
Yeah. A simple rule is to keep your order under 5% of the average daily volume. If you're bigger, you have to use things like time slicing, breaking up one big order into lots of little ones over time.
It's all part of that disciplined process.
It is. Which brings us to, I think, the most important part, the behavioral edge. Understanding the who.
Part 3.
Yeah.
This is where the framework really shines, I think.
The book breaks it down into 3 types of players. You've got the smart money patient, they buy fear. You have retail traders emotional, they chase hype.
FOMO.
Total FOMO. And then you have the algorithmic systems. They're just about speed and exploiting tiny inefficiencies, no emotion at all.
And the whole market drama plays out in what the book calls the 10-stage crowd psychology cycle.
It's this incredibly predictable emotional wave.
From bottom to top and back again.
And if you just focus on the extremes, it's so clear. The cycle starts in disbelief. The news is terrible, prices are cheap. That's when smart money is buying.
And it peaks at thrill and euphoria. This is the top, not because of bad news, but because of just unshakable confidence from the crowd.
The Bitcoin cycle in 2017 is the perfect case study.
Oh, yeah.
The peak at $20,000 wasn't a technical signal. It was your taxi driver telling you to buy. It was everywhere. That was the signal that smart money was distributing, they were selling.
And after that, euphoria collapsed.
You hit desperation and capitulation, maximum pain. Everyone agrees the asset is dead and gone forever.
And that's the bottom.
That is the exact moment smart money starts aggressively buying again. The key takeaway is that markets top on peak enthusiasm, not necessarily on bad news.
So what drives this cycle? Over and over again, the book points to our own brains. Cognitive biases.
Yes, these predictable mental shortcuts that make us irrational. The
Mhm.
biggest one is loss aversion. We feel the pain of a loss about twice as much as the pleasure of a gain.
Which is why people hold on to losing trades forever,
Yeah.
just hoping to get back to even.
And they sell their winners way too early, just to lock in that little bit of good feeling.
Yeah.
The edge is to do the opposite. It's emotionally brutal, but that's the edge.
Another big one is anchoring.
Anchoring is when we get stuck on a number. Our entry price, an old high, a big round number like $100.
So what's the play there?
You fade those breakouts, you bet against them, knowing that a whole wave of retail traders anchored to that price are about to provide you with liquidity.
And the last one, overconfidence. That's the one that blows people up. Too much leverage, no stop losses.
I've solved it. I can't lose.
Famous last words.
Which is why the final piece of the puzzle is the contrarian trading framework. It's all about discipline. The number one rule is you never, ever trade on sentiment alone.
So you see the extreme fear, you see the VIX spike above 30, for example, but you don't just blindly buy.
You wait. Because sentiment can stay extreme for a long, long time. Long enough to wipe you out. You wait for price confirmation.
What does that look like?
It could be a big, powerful, bullish candle on the daily chart, a clean break of a downtrend. Something tangible in the price action that says, okay, the tide is actually turning now.
The sentiment gives you the why, but the price gives you the when.
That's it, perfectly. And this entire system, from the top down, is designed to replace guesswork with a repeatable process.
The sustainable edge.
And the book defines 3 types of edge. There's informational, which is almost impossible for retail. There's technical, which is accessible. And then there's behavioral.
Which the book argues is the most durable, the most sustainable edge of all.
It is, because human nature doesn't really change. The algorithms change, the patterns change, but fear and greed, they're constants.
So the market evolves, but people keep making the same mistakes.
Right. And because all edges eventually decay, you have to keep learning. The book provides tools, calculators, handbooks, because you have to treat this like a business. You have to adapt faster than the market does.
So let's bring this all home for you, the listener. The author, Sir Margin, dedicates this whole framework to the 90% of traders who fail.
They fail because they don't have this kind of systematic process. They don't have the self-mastery.
And if the greatest edge is behavioral discipline, if the market truly is, as he says, the ultimate mirror, then your real work as a trader has to start internally.
It does. And the provocative thought we want to leave you with is this. Before you spend another minute looking for the perfect indicator, open up your trading journal. Look at your own history.
What's the pattern?
What's the pattern in you? What emotional trigger, what cognitive bias is costing you the most money right now? That's your first and most important edge to fix.
That's where the real mastery begins.
That's it.
That is some homework that goes far beyond the charts. Thank you for diving deep with us today.